we are basically talking the whole day about the same concepts, more or less. We tried as organizers to formulate ingenious topics for the individual panels to give as many people as possible the chance to present their views and perspectives. So we have formulated the topic for this panel, excessive risk and compensation. So Wayne already pointed in the previous session to the question, how do we define excessive risk and what is the difference to normal risk? Perhaps you can give us an answer now. But let us start with Lucian, actually. Please, now it's your turn first.
Thank you.
There you are.
15 minutes, you say?
15 minutes, yes.
Okay, so I'll use a little bit of time allotted to me to describe several papers that are in the materials of the conference, and also to comment how they relate to the discussion thus far. So all three papers that I'll mention quickly deal with the question that we are focusing on here today, and I'll try to give you a sense both of what my co-authors and I think about those issues, and also how those different pieces fit together. So as we see, there are two different problems that we should really keep separate. They are connected to this issue that we discussed earlier today about problems that come from a manager side and problems that come from the shareholder side. One problem is a problem that we can refer to as a short-term distortion. That's really a problem that has to do with the divergence of interest between managers and shareholders. That's really a problem that has to do with the fact that the managers don't internalize some of the adverse consequences of risk-taking for shareholders. And that's a result when managers can take some substantial amount of money off the table before payoffs are realized for shareholders. Jesse Fried and I place substantial emphasis on this problem in a chapter in our book, Pay Without Performance. There are now many who would accept that we need to eliminate this problem, although there is disagreement as to how much practically this problem played a role in the last crisis. One little piece in the materials of the conference, and it was mentioned earlier today, is a piece with Alma Cohen and Holger Sparman called The Wages of Failure. And what we do in this case study is to look at Bear Stearns and Lehman Brothers. There have been various media accounts and other accounts that assumed that the executives or those critical players in the crisis, that the executives of those firms saw their personal wealth wiped out with the firms, and therefore that at least with those firms, flawed incentives could not play a role. This might have been a product of the executives having hubris, having misperceptions, or something like that. What we did was to, just using SEC data, is to document that actually those executives did not see their wealth wiped out together with the firm. And it's not what Bruce was mentioning earlier today, that maybe they have $20 million or $50 million, and for all of us this feels comfortable, and then who cares about the next 200 million? It's more that they actually came out with big money, no matter what your skills are. We find that during 2000 to 2008, if you take a sufficiently long perspective, you find that the top 5 teams derived out of the firm, if you look at bonuses and equity sales, 1 billion and 1.4 billion respectively. And that's much more than the value of the initial holdings they had to start with, which means that their net monetary payoffs for this period in which the long-term shareholders were largely decimated, their monetary payoffs were in the hundreds of millions net positive. And that means that at least we shouldn't rule out the possibility that float incentives were at work. Now, second question that I want to touch on briefly is, suppose you accept that we don't have sufficient alignment with long-term results. How should you go about doing this? Jesse Fried and I have a paper which is in the materials that provides a very detailed blueprint of how to design compensation to tie it to long-term results. There is a part that has to do with bonuses and bonus banks. This was mentioned before. But we spend a lot of time on equity compensation. And with equity compensation, here's the way we would go about it. So the basic principle doesn't have to do with this question that people were mentioning before, how quickly equity incentives should vest. Equity incentives should vest the moment somebody earned them, and they shouldn't be taken away from them. But we should, and this is an idea we put forward in our book, Pay Without Performance, we should generally separate the point in time in which equity incentives vest, which is when the executive earned those equity tickets, and even if they leave the firm, those equity tickets belong to them. We should separate this point in time from the point in time in which the executive is free to cash those equity tickets, and those 2 points in time shouldn't be the same. The point in time in which you should be free to unload the options shouldn't be, Brian mentioned here today, maybe we should have the executive never cashing out and the grandchildren should still keep it. So this, I feel great because that means that Jesse and I are really very moderate because we actually would let executives cash out because we think that otherwise the rewards are not really there if the money is there but they can't really use it. We also don't want to tie this to retirement. There are some reform proposals that say you should keep the equity tickets until you retire or 2 years afterwards. The problem with this is that this provides perverse incentives to retire. So if you have a large portfolio, you might be, instead of having retention incentives, you will be incentivized to leave. And that's especially perverse because this would be especially powerful for those executives who have been successful and have an especially large portfolio. So what we want to do is not to distort the retirement incentives, and the way to do it is to have vesting delay that is independent of retirement or anything else in the executive's control. And there are 2 elements here. One element, grant-based limitations, is you get a grant, and the grant should become unloadable only gradually over a period of time, let's say 20% each year over 5 years. The second, which is especially important for firms like Bernstein and Lehman Brothers, where executives served for a long time, if you look at what happened there, they had some limitations, but because people served for a while, they got to a situation in which they were able, if they wanted to unload most of their portfolio tomorrow. And we think the executive should never be in this situation, and the way to deal with this is to have aggregate limitations on unwinding by saying something like, each year you can unload not more than 20% of your portfolio, which means by construction that the weight you give to next year short-term stock prices is not going to be more than 20%. We have also anti-gaming arrangements that try to take away the use of inside information at the time of cashing out. And last piece that I want to just to put on the table because I think it's practically important. In the future, we are going to have, hopefully, some limitations on unwinding. And if we are going to have that, then having anti-hedging arrangements is extremely important. What do we mean by anti-hedging arrangements? You need to have restrictions that would prevent executives from entering into any hedging or derivative transactions that would have the economic consequence of undoing the effects of the equity tickets, because otherwise we are not really doing much with the money that we are giving them in terms of incentives. And there is empirical evidence that this has been going on. And if we go in the directions of limitations on unwinding, you will have much more of this happening unless we place limitations on it. The last part of my remarks, and again it's connected to what we were discussing earlier today, and that's based on our work with Holger Sparman called Regulating Bankers' Pay. The focus of this work is on a problem which is conceptually separate and distinct from the short-term problem. And the way to think about it is imagine that we don't have any short-term problem. Everything is tied to long-term results. The question is still long-term results for whom? And if we have only long-term results for shareholders, then the executives are going to be not taking sufficiently into account adverse consequences for bondholders and the government, which means we'll have excessive risk-taking. And that's something which was already discussed. Now, the proposal we put forward for addressing this in our paper is to say, conceptually, what you want to do is, if you want the executives to maximize the size of, quote unquote, the pie as a whole, the pie for all those that contribute capital, then instead of giving them a slice of the equity, let's say instead of giving them 4% of the equity, you might give them a percentage, would probably be a lower percentage, let's say 2% of the equity, 2% of the preferred shareholders claims, 2% of the bonds, and lastly, you also want to give them 2% of the adverse consequences for the government. The way we dealt with this practically, and this is connected to what Patrick and Hamid are trying to do, is to say you should give them also 2% of the change in the probability of default implied in the price of credit default swaps multiplied by the depositor's base. But in whichever way you go about implementing it, the idea is that you would improve incentives by expanding the objective function to include not only consequences for equity holders, but also consequences for other contributors to the capital of the firm. Let me now turn to the role of the government. Should government have a role here? And I would like to suggest to you that the government should have two roles, and those two roles are connected to what I was saying earlier today, that we have two problems, and we don't have to, both problems exist. We shouldn't choose that one exists or the other. Both problems exist, and we need to do something about each one of them. So first of all, we should strengthen the rights and tools of shareholders, keeping in mind the fact that in the US, the rights of shareholders are weaker than in the UK or any other common law country. And what that would do is prevent or make less likely all those structures that make executives disregard some losses to long-term shareholder value that come from the ability to take money off the table in the short run. But that would still leave the other problem that I was discussing, namely that even when the shareholders have enough power that managers and the setting of compensation arrangements would avoid short-term rewards and therefore they would be focused on long-term results, we'll still have the second problem that you still have somewhat excessive risk-taking from the perspective of society as a whole. And that means that in the financial sector, unlike other sectors, where we take the view that the government should just strengthen the rights of shareholders, improve internal governance arrangements, but then not intervene in the substantive terms of compensation. In the financial sector, we have reasons to have government intervention in the substantive limits, and the reason is simply the very traditional rationale why we have prudential regulation. Because the whole idea of prudential regulation is there is a fundamental moral hazard problem. We cannot count on shareholders to make the right choices because they prefer excessive risk-taking. And if you accept this, then you should also accept that shareholders might have an interest in pay arrangements that encourage risk-taking too much. So what we recommended in our article is what Jeff was mentioning before lunch and what the Fed is doing. Supervisors, bank supervisors, should also monitor and sometimes place some limits on. Thank you.
2 minutes.
I thought I'd get more time by coughing. But, okay. So what they should do is they shouldn't focus on level, but they should focus on structures. And this kind of supervision complements nicely the other standard tools of prudential regulation. Indeed, when you monitor pay structures, then other regulations can possibly be less tight. And conversely, if you are not regulating pay structures, then other regulations should be tighter. You know, there are all kinds of standard objections to any government intervention. Maybe I'll talk about them briefly. One is that regulators are going to be at an informational disadvantage. But that's true also with other forms of prudential regulation. And the fundamental problem is that the people on the inside might have more information and they are better positioned, but they don't have the right incentives. Okay, let me stop here so the supervisors of the session don't view me as.
No, just finish it up quickly if you can.
Well, I think that by now, hopefully, you have.
No, everyone needs to get to the end for them.
It's to compensate for my otherwise disadvantages. So it's an affirmative action, sort of. So, as you have seen, I discussed two kinds of problems. One is the short-term problem. I think that we would all accept that regardless of how practically important this problem was in the past, it would be good to tie things to long-term results in the future. No reason why not to do it. The question is how to do it. Here the devil is in the details, and the work that we did tries to provide a blueprint for doing it that would be both effective without being too costly. And the other dimension is that we should think about doing more and beyond just strengthening shareholder rights, and we should consider making supervision of pay structures a valuable and important piece of the toolkit of financial regulators.
Okay. Thank you very much, Lucian. And René, you can start immediately.
Okay. Which one is it? This? No?
Could it be this one?
This one. Forward.
Thanks. I want to thank the organizers for inviting me. Bruce said that after lunch the speakers should try to be entertaining. Well, I come from Switzerland, and entertainers are not born in Switzerland. They go to retire to Switzerland. And so it's hopeless. But I thought the topic was regulating bank compensation, and it seemed to me it makes sense to start with reasons to be a little bit humble about regulation. Now, if you look at the US, the formal regulation for US depository bank has been very high. The World Bank has indices of regulatory tightness, and the US scores towards the top on all those indices. Now, if you do anything with banks, you know that the regulators examine whether people take vacations. But in practice, the regulators stood back for a number of years. Fannie and Freddie were very highly regulated. The investment banks were relatively weakly regulated. The hedge funds were not regulated at all. Well, when you look at the crisis, the unregulated hedge funds did pretty well. The investment banks became bank holding companies. Fannie and Freddie have and are making just absolutely enormous losses. And the commercial banks, now if somebody had told you that US real estate was going to lose a third of its value, you would say, well, I mean, we came through maybe better than you might have expected. And you might say that securitization had partly something to do with that. Now, the big fact in what happened is really real estate fell by 1/3. The market did not anticipate such a fall. And when you look at the banks, now they were holding AAA tranches, and those tranches that would have been immune to most possible falls in real estate certainly weren't immune to falls of the magnitude that took place. Okay, when you look back at before the crisis, those tranches were not viewed as risky by regulators. Now the people who you want to regulate excessive risk-taking. They were not viewed as risky by investors. They were not viewed as risky by bankers. They were not viewed as risky by raters or by pundits. Now, you will have people who will say, well, gee, we knew. And some honestly did say negative things about those tranches, but the consensus was as I describe it. So it's not like now in 2006 people knew that we were taking excessive risk and we're talking about it everywhere. Some people knew, but most thought that those tranches were pretty safe. Now, so investing in AAA securitization tranches was not viewed as excessive risk-taking, not from the regulators, but also not from the shareholders. Okay, so I think now when we talk about excessive risk-taking, we really have to be careful. Now, exposed a risk that turns bad will be called excessive risk-taking. But you have to put yourself back into the position that we were in 2006. Okay? And so the question is, now in 2006, now from the perspective of the shareholders, were banks taking excessive risk? I would say no. And how do we know from the perspective of the shareholders that we are taking excessive risk? How would we quantify it? That seems to be a hard thing to do. But so looking at the incentives of CEOs from the perspective of shareholders, now did they have the wrong incentives before the crisis? And did that lead them? So now when you look at the CEOs in 2006, which is a year before the crisis, that's really the right time to examine their incentives in terms of actions that could affect the risks that the bank started the crisis with. Okay, Lucian talked about now the money that they took out. I don't question that work at all, but it doesn't tell us what the incentives were at the time, just before the crisis, which is really the relevant question for risk-taking that did lead to was associated with the crisis. Okay, and so if you look at the incentives just before the crisis, now I suspect that if you had gone to Lucian, and maybe I shouldn't be referring to him here, but if you had gone to him in 2006 and said, well, there's this firm where equity ownership is 10 times annual compensation, I don't think he would have spoken very negatively of that firm. Now, obviously, the discussion would have gotten more complicated and more subtle, but no, your first reaction when you hear that is, well, equity ownership is really very substantial, and that's going to guide a lot of the decisions that the CEOs would make. Now, they have a lot of money to lose, and their interests are well related to the interests of the shareholders. Now, kind of the equity ownership was better than for industrial firms. But then when you look at the firms in which CEOs had the largest dollar investment, those were Bear Stearns, Lehman, Merrill, and Countrywide in order. Okay, and so having extremely large dollar investments in the firm now seems to be associated with ex-post poor performance rather than good performance. Now, those holdings, most of them were voluntary. Now, it wasn't that they were holding shares that they had to hold. They were holding shares that they wanted to hold. So in the paper with Fallenbach that has been mentioned, now we related the performance of the banks during the crisis to the incentives in 2006, to the situation of the banks in 2006. Okay? And what we find is the cash bonus proportion of the salary really doesn't matter. The dollar ownership, now the sensitivity of the wealth of the CEO to changes in the value of the shares, that has a negative coefficient. Now, so that the greater that sensitivity, the poorer the performance. Obviously, it would be silly to interpret that result to say that in general you shouldn't have sensitivity. Now, what it tells you is, one interpretation is that the CEOs, now with that high sensitivity, did take risks that in this instance turned out to work out very poorly. No, they were in AAA tranches, and they were in the housing market, and it didn't work out. We also look at the sensitivity towards risk. It never comes out negatively. In some regressions, it's actually positive. Now, so it's very hard based on that to say that having had more options somehow led to worse outcomes during the crisis. So bottom line, cash bonus doesn't matter. Banks of CEOs with more equity sensitivity did worse. Banks of CEOs with more volatility sensitivity did better for some measures, but not other. Now, this evidence is certainly consistent with CEOs who are maximizing shareholder wealth as they went into the crisis. It could also be consistent, though, with what Jose was talking about. Now, he said he didn't find a role for equity holdings at the start of this period, but obviously the banks that did well CEOs ended up with a lot of equity holdings. I have another paper with Andrea Beltrati where we look across the world, and it has a very related result. Now we look again in 2006. We don't look at ownership, but we use an index, the risk metrics index, of how friendly to shareholders the board is. Okay, and so what we find there is similar to the US paper in the sense that the banks with more friendly to shareholder boards actually performed more poorly during the crisis. Now it's again that when if you were maximizing shareholder wealth in the run-up to the crisis, you ended up with those types of risks that worked out poorly. You didn't expect them to work out poorly, obviously, but it so happens that they did. Now, in that paper, we also look at regulation. Regulation explains just about nothing of what happened to banks across the world. Now, so it doesn't, the other thing, it doesn't expect the risks of banks before the crisis. Now, the countries that were tougher in terms of regulation didn't have banks that looked less risky by, say, the measures that Bruce used or other measures. So, what do we learn? US bank CEOs had incentives to maximize shareholder wealth by at least the usual standards, and better incentives or more shareholder-friendly boards don't seem to have helped. So what about short-termism? Well, we talked a lot about short-termism. That's not me. And now this notion that CEOs with large stakes have incentives to make short-term gains do CEOs with large stakes have incentives to make short-term gains at the expense of long-term value? Well, if the market is efficient, you would think not. Now, if the market can figure out the long-term implications of the decisions, then you wouldn't have those implications. So if you now come to the conclusion that given those stakes that the CEOs had, they had short-term incentives, you really are saying that the market wasn't efficient and couldn't understand what those CEOs were up to. Now, and that's quite possible. But then we have to be concerned about a lot more things than compensation. It would seem like the accounting wouldn't make much sense. Now, if the market is not efficient, then mark-to-market fair value across every aspect of the bank seems to be problematic. So now what does then all this tell us? Well, especially the international evidence is striking. The banks that did very well immediately before the crisis actually turned out to do more poorly during the crisis. Now, so if you were a CEO in 2006 and you looked at your stock price, you could certainly think that you were doing the right thing by your shareholders. So that leads me to conclude from both papers now that governance issues, when viewed from the shareholders' perspective, were not a first-order problem in terms of causing the crisis or the performance of the banks. But is that the right perspective to take? No, if as taxpayers we end up footing the bill, then you also have to worry about governance from the perspective of taxpayers or the economy because of the implications of systemic risk. Well, if you are a shareholder in a financial institution, now you are not going to take systemic risk, the implications of systemic risk, into account in the same way as you would if you are a taxpayer or if you are some kind of central planner for the economy. And so in that sense, now there is a role for regulation to try to force the shareholders to internalize these externalities. So I think it's really important in all this to distinguish between shareholders and the taxpayers. So I'm part of a group which is called the Swan Lake group, and we have proposals. We actually are going to have a conference here in a week and a half to launch the book that Princeton University Press is publishing. It's just a little bit of advertisement here. But we have proposals on compensation. Now, we think that the regulators should not regulate pay levels, But we are in favor of clawbacks if an institution ends up having to be bailed out. And we are in favor of part of the compensation to be set aside, not in the form of equity, but in the form of debt, so that, I mean, in some sense, it leads to results that might be similar to the one of the paper by Hamid on Patrick. We also, now this morning, we didn't discuss about capital requirements, but we want them to be sensitive to the systemic risk that an institution creates. So just some related issues to conclude. Now, there is more so in Europe than in the US, but even in the US, there is a big movement to try to have regulators interfere with compensation across banks, not just at the top level. And I think we really have to ask ourselves whether now regulators have the right incentives to look at that, whether they have the knowledge and ability to do that. Now, the compensation design issues within banks are quite complex. You really need to understand a lot about the risk management. You need to understand about the nature of the work that somebody is doing. It seems that having that regulated in detail is going to be possibly quite counterproductive. Now, when we talk about regulation of compensation, it's also important to understand that people have alternatives. Now they can move to a less regulated sector of the economy. Activities can move to a less regulated sector. And any kind of discussion of compensation should take that into account. Charlie was very eloquent about the role of politics. Now, I think the more we do about regulation of compensation, the more we are going to see politics become a big consideration in the working of banks, and that would seem to lead to an allocation of capital that might not be the best. I think I have been so quick that I have maybe 15 minutes left.
Really?
No, I think we should be. Now, when we think about regulation, it's really, and of those things, it's really important now to be humble, as I said at the beginning. Now, and I can conclude with a story about kind of why we should, that shows that we should be humble. That there are results that we don't typically expect. Now, I was on the board, I still am on the board of a holding company. We have a board that in terms of finance talent is hardly matched anywhere, in terms of academic talent, understanding risk management with people having lots of experience. And we had a bank in Los Angeles. Now, we are fantastic. Now, we had now our loan losses are minimal on the loans we made, but so we had very tough standards on what we were willing to do. We didn't go in any of those funny mortgages. Okay, but then you end up having a lot of cash that you have something to do with. Okay, and so what do you do with it? Well, you put some in WAMU bonds and you put some in Fannie Mae preferred. Then your life gets interesting. No? And so that's an example where doing everything right on one side of the risk equation led us to take risks that came back to bite us, that probably nobody would have expected, that you could make big losses on those securities. Thank you.
All right, thank you.
Thank you, René. Wayne, you are the next.
This one?
Let's see. No, not the draft.
Okay.
There's another one there.
All right. This one. Nice.
Okay, well, like René, I'm going to thank people for thank the organizers for inviting me here, and I'm also going to pass off the entertainment to Peter, who will finish up with the entertainment for the afternoon. So this discussion is, I have excessive risk in quotations here, primarily because of my I guess, ignorance as to exactly what that means. I expressed that a little bit this morning in the prior panel session, and that might come up to some extent. And I would also note that the comments I'm making here are, a lot of the work has come out of work that I've done with John Core, so he was very helpful with the presentation as well. So I'm going to start out with just some quotations here. I mean, I think, this sort of, to my mind, sums up sort of some of the controversy. Secretary Geithner says this financial crisis has had many significant causes, but executive compensation practices were a contributing factor. Alan Blinder, poor incentives are one of the most fundamental causes of the credit crisis. On the other side of the coin, Michael Jensen, in conjunction with Kevin Murphy and I cannot find the seeds of the financial crisis in commercial investment bank compensation plans. And David Yermak says the recent scrutiny of executive pay seems to stem from an odd mix of envy and vengeance, unsupported by facts or theories. Okay, so maybe the counterpoints is sort of an academic versus a non-academic perspective. I don't know, but it, it certainly highlights some of the debate here. So some of the explanations that at least I've heard, common explanations for excessive risk-taking would be these things. Too little focus on shareholder performance, and René and Lucian both pointed to that a little while ago. Too much focus on short-run rather than long-run performance, again pointed out by the two previous discussants here. And then stock options as a potential cause for excessive risk. And then last, high leverage of banks and the public safety net that might promote risk-taking. So I'm going to go through these in turn, actually, and say a little bit about each one. So the first one is, was there too little focus on shareholder performance? And René pointed out some interesting facts, and I fully agree with what he said. I'm going to point out a few more. U.S. CEOs clearly have several times more performance incentives than CEOs in other countries, in all of the countries as far as I'm aware. Bank CEOs have more performance incentives than other non-bank type CEOs. And as a side note, I'm going to talk a little bit about the Feinberg proposals that Special Master Feinberg, who has put in place some changes to compensation for the special assistants or exceptional assistant TARP firms. So just a few quick charts. This comes out of work that I've done with John Core and Martin Conyon. It's sort of U.S. CEO incentives as compared to UK CEO incentives or a group of European CEO incentives. The picture on the left shows equity incentives as measured as the sensitivity of the CEO's portfolio of stock and options to changes in stock price for U.S. CEOs and a matched sample of UK CEOs. And you can see it's several times larger for the U.S. CEOs. On the right, a similar type picture, only for a broader group of European CEOs. Again, many times more incentives for the CEO of the U.S. firms. Just some facts and figures. This is work that John and I did as well. It's comparing a group of large banks with a matched sample of non-financial firms. Again, getting at the levels of CEO incentives. This is all within the U.S. And again, it's a sensitivity of their stock and option portfolio to changes in stock price. And at least banks have somewhat greater incentives than non-financial firms, at least indicating they're certainly not outliers in the low incentives category. So again, it seems they're holding very large portfolios of stock and options. And as a last figure here, this is also work that John and I did, trying to just get a handle on how Ken Feinberg's adjustments would affect the pay per performance sensitivity of the CEOs that he's regulating or making changes to. And not surprising, I think, when you think about it, it really looks like it's going to have no effect, or at least a minimal effect, on pay per performance incentives. For those of you that aren't aware, Mr. Feinberg's proposals are that cash pay should be no higher than about $500,000, and that basically all the compensation, or most of the compensation, should come in the form of equity. So the blue bars here are salary, other pay, and equity pay as these firms would be without Mr. Feinberg's proposals. And then the red bars are what they would look like under Mr. Feinberg's proposals. And you can really just see that what he's doing is adding a little bit of equity pay to the third bar over there and taking that away from some cash pay. But really, when all is said and done, the 800-pound gorilla is the $130 or $40 million in equity that these guys hold. And so adding $1 million or $2 million, $3 million of equity pay to CEOs who already get most of their pay in equity seems unlikely to make a big difference. Incentives to focus on the short run. So that's another point that both Lucian and René brought up. The allegation that CEOs have strong but liquid equity incentives. So the story here, I think, is that they pump up the stock price, they dump their equity, and then they do it in such a way that they won't get caught, obviously, for doing that. And if this is true, it certainly implies some unresolved agency conflicts between equity executives and shareholders. So it's not an issue outside of sort of the standard corporate governance arguments between shareholders and managers. This is something shareholders don't want them to do, and so this would imply some kind of a governance problem with shareholders. But this really, in my mind anyway, doesn't have anything to do with risk-taking. It's more likely to manifest in earnings management, distorted disclosure, something they can do to manipulate the stock price, kind of the market inefficiency arguments that René was making. But even the early literature that kind of showed that equity incentives lead managers or CEOs to engage in earnings management practices, sort of pump and dump type stories, recent evidence has refuted those studies based on poor econometrics and some sample selection issues. So that's just sort of an interesting debate that's raging in that literature. I'd also point out another table that John and I put together. The notion, I think Lucian brought this up, that CEOs or executives have a tendency to unwind their incentives. And he brought up a couple of case studies that René talked a little bit about. This table is giving some indication of the unwinding that's going on, at least among a larger sample of firms. So this is a selected sample of financial services firms between 1993 and 2008. The first column shows, basically ranks the CEOs by tenure. How long have you been there? And the second column shows that the longer you're at a firm, the more equity incentives you tend to hold, which would be surprising, I guess, if you were unwinding your incentives freely, but would not be surprising if you would also not be surprising if these CEOs have either implicit or explicit incentives or restrictions on selling their equity. The third and fourth columns provide sort of annual grants of incentives and sales of incentives. And so you can see in the third column that on average these CEOs get $6 or $7 million in new equity grants each year. In the fourth column, you can see that on average they sell maybe $1 or $2 millions of dollars of these incentives. And early on in their tenure, the first few rows, they sell very little. Later on in their tenure, they tend to sell a little bit more. But as a percentage of their incentives, there's not a lot of selling going on. There's a little bit, and I'm sure that you can find examples where there's massive selling, but it doesn't seem to be a pervasive problem. So now move on to stock options, risk-taking from stock options, and I'm going to steal some data from René's paper. And just present some of the figures that I don't think he presented them, but they're in his paper. Annual pay in his sample, mean pay is about $8 million. Value of equity holdings about almost $90 million. And then I sort of grossed up his incentives measures to come up with a measure of the increase in the value of that portfolio for a 10% change in stock price. And you can see it's about $11 million. And then also show what the increase in value of the portfolio would be for a 10% increase in volatility. And you can see that for a 10% increase in volatility, the average CEO would stand to gain about $2 million, 25% of their annual pay and a teeny tiny fraction of their equity holdings. And also note that a 10% increase in equity volatility is massive. Right? These banks on average have about 20% annualized volatility. So a 10% increase would increase the risk of the equity by 50%. So it's a huge increase in equity volatility to get $2 million in additional value and to jeopardize the health of the firm. Maybe this is what's going on, but the magnitudes don't seem quite large enough here. So now I'll go to the last one, risk-taking incentives from common equity as an option on a levered firm. And so people have talked about this in various forms today already. Common equity is an option on firm value with exercise price equal to the face value of the debt. The value that one could get, the option value there is going to be a function of the moneyness, how far in the money that option is. A healthy bank or a healthy firm is going to be way in the money, not a lot of risk-taking incentives there. It's also a function of asset volatility and the maturity of debt. For most firms, there's evidence that empirical research shows that risk-taking incentives from common equity is pretty small. Okay, but of course banks are highly levered, so the question is, doesn't this imply that these CEOs have much greater risk-taking incentives? And my take on it would be maybe, but not necessarily. The majority of these CEOs have a huge chunk of their wealth and human capital tied to a single risky asset. To increase the option value of common equity requires you to jeopardize the stability and the survival of the firm. So you can't increase the option value of common equity unless you jeopardize the value of the firm. I mean, that's the only way you can increase the option value, is to jeopardize that healthy firm. So what I would like to see, and I just don't know any evidence on this, and maybe there's some out there, I would like to see somebody measure the option value associated with this option, this common equity option value. It's been done in broad samples of firms. I haven't seen anybody do it explicitly for financial services. I've done it. I published a paper on sort of a broad sample. I explicitly excluded financial firms because the leverage issue was a tricky one for me to tackle. I'd like to see somebody put a dollar value. I mean, is it big enough to really drive the incentive structure here? If these financial services CEOs act on these quote-unquote excessive risk-taking incentives, we might expect to observe high stock volatility in the financial services industry than other firms. I don't think we do, but it seems to me like the equity volatility is quite a bit lower in banks than for non-financials. At least that's what our data suggests. We might expect to see a greater incidence of financial distress in banks than other firms, and some evidence to the extent, to some proof or evidence that these things actually hold in the data might tell us something about excessive risk-taking, maybe. But certainly when firms approach financial distress or in weak financial health, then that option value inherent in common equity can kick in. And thank you. And there is some empirical evidence that it can start to ramp up once the firm starts to get in near financial distress. So once that option's way in the money for a healthy firm, once the value of the firm drops some, that option value, just like any option that becomes at the money, it can start to get option value or time value from that option component. And so then, there are incentives, and this has been well documented in the literature, to try to shift wealth away from creditors. And then in the context of banks, we've also had a lot of discussion today about externalities that the shareholders may not fully consider at the time of the distress. I mean, ex ante, you'd expect the shareholders to consider many of the creditors because the creditors will price protect to the extent they expect the shareholders to do something funny. But there are certain constituents here like the taxpayers, the FDIC, the stability of the financial system as a whole, where they may not have the ability to fully protect themselves at ex ante. And so this was just an interesting article I saw in the Wall Street Journal on Monday. It was kind of cool data. These are extra credit rating notches and these are the words that were used in the paper, for implied government safety net on debt for banks that are too big to fail. So Moody's and S&P adds additional notches to these banks or these financial services firms' credit ratings explicitly for this government safety net. And it strikes me that as a researcher, if I was going to look for a place to go to try to find which firms have the greatest potential incentive to shift risk or increase risk, this is not a bad place to go think about it. I mean, it seems like this is explicitly what they're trying to model. I don't know how they model it, but it seems like it's kind of interesting. So in terms of the regulatory focus, I think René brought this up a little bit. I mean, transparency, to my mind, seems like a really big issue. Transparency and incentives, as well as leverage and firm health, And then on top of the transparency, maybe some measures, and I'm not sure exactly what, but maybe some measures to ensure that bank executives do consider these public interests. I think it's primarily important as the health of the firm deteriorates. I kind of like Lucian's argument and the Bolton et al. Paper arguments as well about the basket of securities and tying this basket of securities to credit ratings or spreads, which is in the kind of the Bolton et al. Paper. And I kind of like some kind of blend of this. I mean, kind of one of the problems or the questions I have about the Bolton paper is can you get enough incentives in the annual pay for this to really drive incentives, given that the CEO has a huge chunk of stock and options? And the thing that I kind of was concerned about in Lucian's argument is that it seemed like he was suggesting that this basket of securities would be given to the executive ex ante up front, even when the firm's financially healthy. To me, it kind of seems like you want some blend of the two and maybe mix that with what John Coffey was talking about this morning, where the executive, maybe not the shareholders or the creditors or the preferred shareholders, maybe but the executives have equity that transforms, some kind of contingent equity that transforms into a basket of goods that takes into consideration other constituencies in the event that the firm's financial health deteriorates. So that might be another way of doing it. I also kind of liked, René brought it up, the Squam Lake Working Group's idea about deferred compensation and deferring this compensation that the executive only gets or forgoes in the event that the firm gets into distress. One suggestion I had is that supplemental executive retirement plans, the SERPs, have some of these same features. They're deferred compensation that the executive gets once they retire. Now, there are ways that executives have tried to ensure that those things are somewhat funded, but to the extent you could limit the ability of them to be funded, then they really would act as some kind of a deferred compensation in the event. If they're not funded and the company goes under, the employee would lose them. So maybe that's a possibility there. Okay, so I'm basically done here. Just some simple takeaways. Executive focus on short run rather than long run incentives driving excessive risk taking. It doesn't seem to me that that's empirically descriptive, at least in terms of widespread behavior. It seems like executives or CEOs of these financial firms have a ton of stock and options that doesn't get unwound, at least pervasively in a large group. Stock options don't strike me as being a large enough payoff to really drive firms to jeopardize their otherwise healthy firms. And then I think we do need to keep an eye on and focus in on, this is where I think the focus should be on this, the issue with the safety net and the excessive risk-taking in terms of the firms with high leverage. But again, I'd like to see some empirical evidence. I'd like to see somebody show me that the option value in common equity is big. I'd like to get some magnitudes on that. And I hear a lot of reasonable stories, but I haven't actually seen the data on that. So that would be kind of cool to get. Thank you very much.